At some point, nearly every investor reaches the same conclusion. Holding cash feels like the responsible thing to do. When markets feel uncertain, when headlines grow louder, and when outcomes feel harder to predict, stepping back into cash can feel like control. It creates distance from volatility, space from mistakes, and the comforting belief that waiting is the prudent choice until clarity returns. But the modern economy rarely rewards waiting. While cash sits quietly on the sidelines, the world continues to move. Prices adjust, assets reprice, systems evolve, opportunities compound without regard for individual hesitation. This is the modern financial trap, confusing stillness with safety. In an economy defined by motion and compounding, wealth is not preserved by standing still. It is preserved by staying engaged long enough for time and participation to do their work. Cash feels safe because it appears stable and predictable. It doesn't fluctuate with headlines, and it doesn't demand emotional resilience. You can see it, access it instantly, and convince yourself that you're ready for whatever comes next. But stability on the surface doesn't mean protection underneath. While cash remains unchanged numerically, its purchasing power slowly erodes. Inflation doesn't announce itself dramatically. It works quietly, year after year, reducing what each dollar can claim in the real world. The danger of idle cash isn't sudden loss. It's slow disconnection from an economy that continues to move forward, whether you participate or not. Cash is not an asset in the wealth building sense. It is a medium. Its purpose is movement, to be exchanged, invested, and transformed into something productive. When cash stops moving, it stops doing its job. Modern wealth is built through participation. Participation in businesses, in real assets, in systems that grow and adapt over time. Idle cash opts out of those systems entirely. It earns nothing. It produces nothing, and over long periods, it quietly loses relevance. When money moves, it creates second-order effects. A dollar invested doesn't just sit in an account. It funds growth, innovation, employment, and infrastructure. It connects the investor to the productive engine of the economy. This is why assets compound while cash stagnates. Circulation allows capital to absorb short-term volatility in exchange for long-term progress. Stillness avoids discomfort temporarily, but it also avoids growth. The goal isn't reckless movement. The goal is intentional deployment. Many people fear change because it's visible and emotionally uncomfortable. Inactivity feels harmless because it's quiet. Markets fluctuate loudly. Idle cash deteriorates silently. Over long horizons, the greater threat to wealth is not experiencing downturns, but remaining disconnected from the systems that recover, adapt, and compound. Capital that never enters circulation never gets the chance to grow back stronger. In this sense, inactivity is not neutral. It is a decision, and it carries a cost. Holding cash feels flexible in the short term, but prolonged stillness reduces optionality over time. As assets rise and opportunities move forward, idle cash loses relative power. What once felt like patience slowly turns into watching opportunities pass. Circulation creates income streams, asset exposure, and leverage that can be redirected as conditions change. Movement keeps capital relevant within the system. Stillness eventually closes doors. The mistake most people make with cash is not holding it, but holding it without intention. Cash has a role. It provides liquidity, resilience, and the ability to act. Used deliberately, it is a stabilizer. Left idle for long periods, it quietly becomes a drag. Solo investors understand this balance. They don't chase returns, but they also don't confuse waiting with progress. They keep capital in circulation thoughtfully, aware that wealth is built through participation, not avoidance. In a world that continues to move regardless of personal hesitation, Staying engaged is often the difference between preserving purchasing power and watching it slowly slip away. Thanks for watching. This is The Solo Investor.